is Amirul. This is my blog. I'm going to pick up my group mate for group discussion.
اسمع يا اخوي وحيدة ايوه سامع كلامي وصي
ماذا ترى وكذا
Well, let's step outside, kill a bitch, all about my paper, one hand on my yaps.
Where we should pick up the others?
I think they are around here, on.
Look, it's lonely at the top, lot of people are watching and want me to flop. I'm telling the kids if I can do.
All anger. Looking at the truth, the money never lie. No, I'm the one, yeah.
You know what is SME?
SMEs stand for small medium enterprise, usually owned by individuals, more small partnership business, or family-owned business. There are three types of SMEs. The first one is micro enterprise, the smallest form of SMEs in Malaysia. They are usually owned and managed by one person or a family, operate with a very low capital, and have limited or no hired employees. Most micro-enterprise focus on daily cash flow rather than long-term expansion, which makes investment decision very sensitive to risk. I will provide you with the examples of micro-enterprise.
Okay.
The first one is home-based food seller. Second one is a pasar malam food stall. Oh my god. And the last one is an online seller.
Wow, good explanation. So now it's my turn. The second one is small enterprise. Small enterprise have higher capital investment and more organized business structure compared to micro enterprise. They employ several workers, operate from a physical premise, and often aim for growth. Investment appraisal become more important at this stage as owners begin to consider equipment purchase, expansion, or new product lines. So, this is some of the example of small enterprise. First, a local cafe. Second, a small bakery. And then the last one, a retail shop. So, you mentioned that there are three types. So the last one is medium enterprise. Medium enterprise is more established business with a larger capital, higher turnover and formal management system. They may operate across state or supply to large retailers. At this level, investment appraisal techniques are crucial as investment decision involves substantial cost and long-term financial impact.
Oh, I know the example.
Where?
Here. First one is a local food manufacturer, a construction company, and last, a logistics company.
Thank you for your example.
Yeah.
But you know, there are similarity between you and small enterprise. We are both small.
Meledak.
So, what is investment appraisal? Investment appraisal is the process of determining whether an investment or project is worthwhile by assessing its potential profit and attractiveness. It combines several techniques such as internal rate of return (IRR), which determine the discount rate at which NPV is zero, and net present value (NPV), which calculate the present value of expected cash flow minus the initial investment cost. Expected cash flow, associated risk, and the time value of money are important consideration in this appraisal, all of which are essential for making good decisions. Ultimately, investment appraisal help companies and investors prioritize projects according to their return prospect and align investment with strategic objective. So, are you understand? Okay, first, I'm going to teach you about how to compute the tax gain. Okay, first, we are going to calculate the depreciation of all machine for 1 year. We are going to take the cost of all machine, which is 950,000, minus with 100,000, which is its salvage value, and then we will divide it by 10 years. So the amount is 85,000 ringgit Malaysia. And then we are going to calculate the accumulated depreciation, which is 85,000 ringgit Malaysia times with 3 years, because each useful life is only 3 years. So the amount of the accumulated depreciation is 255,000 ringgit. And then we are going to calculate its next book value. How to calculate its book value? So we are going to take the cost of the whole machine, which is 950,000, minus with accumulated depreciation 255,000, and then we will get the amount of 695,000 ringgit. And then we are going to calculate the profit or loss of disposal of this machine. Then first, we are going to take the sales proceed, which is 900,000 ringgit, minus with its net book value, which is 695 ringgit Malaysia. So we will get loss on disposal, which is 95 ringgit Malaysia. And then we are going to compute the tax gain, because we get the amount of loss on disposal. If we get gain on disposal, we are going to compute the tax loss, but in this case we get the amount of loss on disposal, so we are going to compute the tax gain. First, the formula, we are going to take loss on disposal, which is 95,000 ringgit Malaysia, times with corporate tax rate, which is 24%, and we will get the amount of 22,800 ringgit Malaysia. So that's how we are going to compute the tax gain. Okay, so next we are going to calculate the initial outlay. First, we are going to compute all the amount of the cash outflow. First, we are going to take the purchase price of the new machine, which is 2.3 million, add with the custom duty, transportation, insurance, and then we will get the amount of cost of the machine, which is 2.453 million ringgit. And then we are going to add training cost in handling machine, which is 30,000. And then there are add working of capital, which is there are a amount of additional investment on inventory, which is 250,000. And then we will compute all the amount of cash outflow, and then we will get 2.733 million. Then this amount we will less it with the amount of cash inflow. The cash inflow is sales proceed of old machine, which is 600,000, and tax gain that we are compute before in the working, which is 22,800. We will plus these two and get the amount of cash inflow, which is 622,800 ringgit. Then we will take this amount of cash outflow less with the cash inflow, and then we will get the amount of net initial outlay, which is 2,110,200 ringgit. This amount we will use to calculate the NPV and IRR. So then we are going to calculate the differential cash flow. First, we are going to calculate the amount of increase in sales. The amount of increase in sales is 600,000. This we get from the amount that the sales generated by the new machine, which is 3.8 million, minus with the sales generated by the existing machine, which is 3.2 million. Then we will get the amount of 600,000. And then there are a decrease in cost of the defects, which is 105,000. How we get this amount? This amount we get from the amount spent in cost of defect by the existing machine is 150,000, minus with the cost of defect spent by the new machine, which is 45,000. Then we will get the amount of 105,000 ringgit. So we will add these two amount, and then we will get 705,000 ringgit. Then we will minus with the cost. The cost here is increase in annual overhead cost. The annual overhead cost is 200,000 increase. How we get this amount? This amount we get from the amount spent by the existing annual overhead, which is 500,000, and then there are investment to 700,000 by the new machine, and then there are increase in depreciation, which is 236,857,000. So we will add these two amount, and we will get the total amount of cost, which is 436,857 ringgit. And then we will take the amount of benefit minus with the amount of cost, and then we will get the amount profit before tax, which is 268,143 ringgit. So there are a tax charge. How we get this amount? We are going to take the profit before tax, which is 268,143 times with the 24%, and then we will get the amount, which is 64,354 ringgit. This is the amount of tax charge, and then we will take the amount of profit before tax minus with the tax, and then we will get the amount of profit after tax, which is 203,729 ringgit Malaysia. And then we will take the amount of the depreciation, we will add back here, which is 236,857 ringgit, and then the amount of after tax differential cash flow is 440,646 ringgit Malaysia. So that's all how we compute the differential cash flow. This is the amount. First, before we calculate the differential cash flow, we are going to calculate the working in increase in depreciation. First, we are going to take the cost of the new machine, which is 2,453,000 ringgit Malaysia. Then we will calculate, we will using this amount to calculate the depreciation for 1 year for the new machine. So the cost will minus with the salvage value, which is 200,000, and then divide by 7 years, and then we will get the amount of 321,857 ringgit. And then the depreciation 1 year for the existing machine, which we calculate before in the initial outlay, then we will get the amount of 85,000 ringgit Malaysia. So using these two amount, we are going to calculate the increase in depreciation. We are going to take the amount of depreciation for 1 year of the new machine minus with the depreciation for 1 year for existing machine, and we will get the amount of increase in depreciation 236,857 ringgit Malaysia. So this will be the amount of working increase in depreciation. So the last thing we need to calculate is terminal cash flow. First, we are going to take the salvage value of the new machine, which is 200,000 ringgit, and then we are going to add with the working capital received, which is inventories. So the amount of inventories is 250,000 ringgit Malaysia, and then we will add these two, and we will get the amount of terminal cash flow, which is 450,000 ringgit Malaysia. So all of these three, we are going to use it in the technique how to compute NPV and IRR.
So in this project, we choose two methods for the decision making, which is NPV, net present value, and IRR, internal rate of return. So I will explain the net present value first. So in this table, we include the cash flows, present value, and discounted cash flows. So for the year 0, we put the amount of initial outlay, which is 2,110,200 ringgit. So we put the negative because the amount is outflow, so the money will go out. So we put the present value of 1.0, and then we times present value with cash flow to get the discounted cash flow, which is negative 2,110,200 ringgit.
Bini, but how do you want to get the amount of 1.0?
Oh, this one is present value. We can get the present value amount in the table, which is already prepared in the appendix. So this amount 1.0, you can look at the present value formula, and this is important because we will look at the rate and years. So in this question, this project, we look at the 15%, which is cost of capital, and years is 5 years of payback period. So we look at the table to get the 1.0. Okay, so the next one, 1 until 7 years. We look at the table, 15% and 7 years of present value of annuity. Because 1 until 7 years, the amount is same. The amount of cash flow is same, which is 450,646,000. So we times the cash flow with present value of annuity, which is 4.1604, to get the discounted cash flow, which is 1,833,264 ringgit. So and the last year, which is the year of 7, we put the terminal cash flow, which is the end of the amount, which is 450,000. So we look at the table again, which is present value, because this is only the year of 7. So we look at the table, 50% and add the year of 7. So we get 0.3759, and then we times with cash flow, and we get the discounted cash flow at 169,155 ringgit. And then we total the amount, negative 107,781 ringgit. Okay, for the second method, we choose IRR method, internal rate of returns. So in this table, we have year cash flows, present value, and present value. So the step is almost same with the NPV methods, which is we times cash flow with present value to get present value amount. Okay, so in this present value or present value for annuity, we choose random percentage below than the cost of capital, which is 15%. So we just put random percentage, so we choose 13%. So we can look at the table, the 13%, and we look at the years that we have in here. So 1 to 7 years. So we look at the table, 13%, 7 years. So we get 4.4226, which is in the present value for annuity. So we get present value of 1,948,101 801 ringgit. Sorry. So the end of the year, which is 7. So we put the terminal cash flow also 400,000. So we look at the table again, 13% and the year of 7. So we get 0.4251 at present value table. So we get present value 991,265 ringgit. So we can total the present value amount, total all of this. So we get 29,896. Okay, next step we must calculate the differential of present value of NPV and IRR. The NPV just now, our percentage is 15%. So we must take the discounted cash flow just now for NPV 1 to 7 years, which is 1,833,264 ringgit plus 169,155 ringgit. So we get 2,2,419 ringgit. So we calculate also for IRR present value, take the same amount for 1 to 7 years and the year of 7 of present value. So we take 2 of this, so we add and we will get 2,140,096 ringgit. Okay, so we need to calculate the internal rate of return. So we must calculate the differential of total discounted cash flow from the NPV and the total present value from the IRR just now. So we get the 137,677 ringgit. So for the calculation of IRR, we take the 13% that's on the table above, we plus with the total present value of IRR, including the initial outflow. So we divide with differential of discounted cash flow and the present value, which is 127,677 ringgit. So we times with 2%, which is the difference of 15% of NPV percentage with the IRR percentage, which is 13%. So the differential is 2%. So 13% plus with the amount here, we get 0.4343. So we will get 13.4343%, which is closer to 13%.
Okay, to conclude, the project shows a negative net present value, NPV, which means the present value of cash inflows is lower than the initial investment. It would decrease the company's value instead of increasing it, while the internal rate of return, IRR, is lower than the required rate of return, indicating that the project does not meet the company's minimum return expectation. Therefore, the company should not proceed with replacing the new machine. So to advise the company to not proceed with replacing the new machine, the company can choose to lease the machine instead of buying it. Leasing requires lower initial cash outflow and payments can be made over time, which helps to reduce financial burden. Other than that, the company may upgrade or refurbish the existing machine. This option is usually cheaper than buying a new asset but can still improve efficiency and productivity. Next, the company can try to negotiate better terms with the suppliers such as installment payments, discounts, or extended credit terms to make the project more affordable. Lastly, the company can delay the purchase decision. By postponing the investment, the company can wait until cash flow improve or economic condition become more favorable. That's all for the suggested decision making. So that's all for the suggested in decision making.
SMEs, small and medium enterprises, are also known as SMEs, are typically defined based on criteria such as the number of employees, annual revenue, or total assets. The specific definition can be varied by country and industry. But the common characteristic of SMEs include size. SME are a business that operate on a relatively small to medium scale compared to large operation. SMEs are typically include small shops, service providers, manufacturers, and family-owned businesses, which are independently owned and operated businesses. They play an important role in the country's economic development by stimulating innovation, competition, and entrepreneurships. SME are also known for their agility and ability to adapt quickly to changing market conditions. As I know, at present, there is no standard definition of small and medium enterprise in Malaysia, as different agencies use different criteria such as sales turnover, number of employees, or shareholder fund. For a company like Rumbia Berhad, this can create confusion in determining whether it qualifies as an SME, especially when applying for government support or financial assistance. Having a standard definition of SMEs helps ensure better identification of businesses across all sectors. This allows the government to design effective SME policies and provide appropriate financial and technical assistance, particularly for companies like Rumbia Berhad. They are planning major investment such as upgrading machinery to increase production capacities. The common SME definition, approved by the National SME Development Council on 9 June 2005, ensures consistency among government agencies and financial institutions. These provide fairness and clarity for SMEs like Rumbia Berhad when seeking support, incentive, or financing for business expansion. For definition of an SMEs will be based on two criteria, that is number of employees, annual sales turnover. So any business that fits the criteria for either the specific number of employees or annual sales turnover, definition is considered as SMEs. In Rumbia case, the classification of Rumbia Berhad is assessed based on annual sales turnover since the number of employees is not provided. The definition of SMEs will apply for the following sectors: primary agriculture, manufacturing, including agro-based, manufacturing related services, MRS, and services including information and communication technology. Rumbia Berhad operates in a manufacturing-related activity as it involves in production using machinery. Hence, it falls under manufacturing, including agro-based sector. To ensure consistent and comparable data across sectors, SME in the mining and acquiring as well as construction sectors are classified using the SMEs definition for the service sectors. SME classification should be based on the Malaysia Standard Industrial Classification MSIC 2000 codes to ensure consistency and comparability of data Romeo's neighborhood operate in the manufacturing sector. So, its business activity should be classified under the relevant MSIC 2000 manufacturing code. This helps ensure that Romeo's neighborhood is properly classified as SME within the correct sector. The approved SME definition are not final and may be updated or expanded by the National SME Development Council from time to time to reflect the changes in business and operating conditions. Therefore, Romeo's neighborhood is currently classified as an SME, but this classification could change later if the definitions are updated.
Hey, what's up? Oh, you want me to explain all the definition of SME? Sure. So there's actually a few definitions of SME and it differs from each industry. Let's start with primary agriculture. The SMEs under this industry generally means an enterprise with full-time employees not exceeding 50 or annual sales turnover not exceeding 5 million ringgit. However, if you want to be more specific, micro enterprise in this industry means an enterprise with less than 5 full-time employees or with annual sales turnover less than 200,000 ringgit. While small enterprise is an enterprise with 5 to 19 full-time employees or with annual sales turnover between 200,000 ringgit and 1 million ringgit. And lastly, for medium enterprise, it is an enterprise with 20 to 50 full-time employees or with annual sales turnover between 1 million ringgit to 5 million ringgit.
This is Saki Remix.
Oh, for service industry. Well, services and information and communication technology, ICT, practically have the same definitions of SME as primary agriculture. No, for manufacturing industry is a bit different actually. The limit for manufacturing industry is a bit higher because obviously you need a lot of employees to start manufacturing business and higher expected annual sales turnover. In this industry, SMEs are generally defined as enterprises with full-time employees not exceeding 150 or with annual sales turnover not exceeding 25 million ringgit. More specifically, a micro manufacturing enterprise has less than 5 full-time employees or with annual sales turnover of less than 250,000 ringgit, whereas small manufacturing has 5 to 10 full-time employees or with annual sales turnover between 250,000 ringgit to 10 million ringgit. Oh, if I'm not mistaken, it's exactly like the company that you are evaluating right now. Romeo Sendirian Berhad. So they're a small manufacturing enterprise because the annual sales is just around 3.2 million ringgit. One last thing, medium manufacturing enterprise has 51 to 150 full-time employees and annual sales turnover between 10 million ringgit to 25 million ringgit. Alright, so basically, SMEs are grouped by size. And sales, agriculture and services go up to 50 employees or 5 million. Then we just break them into micro, small or medium enterprise, depending on the numbers. So that's pretty much it. Okay, you're welcome. Bye-bye.
So today we are actually looking at how SME policies are actually applied in Malaysia. Imagine we are a company like Rumbia's Neighborhood. We are about to invest 3 to 4 million in a new machine. So how does the government decide if we deserve the help? According to paragraph 4.1, there is 4.1 and 4.2, there is a mandatory approved definition. This means every ministry, state agency and bank must use the exact same criteria to identify an SME. For Rumbia, this is vital because their sales are 3.8 million. They are consistently qualified as a small enterprise across all platforms. This ensures that they get the correct 24% tax rate and eligibility for SME specific support. So moving forward to paragraph 4.3, how do this agency actually track Rumbia? They use 2 main rules: annual sales turnover and the number of full-time employees. If an agency can track both, they must report it to the secretariat. But in our Rumbia case, we actually focus on their sales, which is increasing from 3.2 million to 3.8 million. However, the policy ensures that even if their sales grow, the government also check their employee count to make sure they still fit the small category. As per paragraph 4.4, this harmonized data helps the government understand if automation is actually solving industry issues or creating a new one. So now, how do we stop paperwork from getting messy? Section 5.1 introduced the common identifier. This is simply the company registration number. Think about Rumbia case, which is 22.8 thousand ringgit, which is tax shield we calculated earlier, which is because of this common identifier, the tax office, which is LHDN, can cross-reference with the bank. They can see that the same Rumbia's neighborhood that bought the machine is the one claiming the tax benefit. So it is of verification at its best.
We can do this together. Bet you feel better when you
So, finally, who ran the show? Section 6 introduced us to the Secretariat to the National SME Development Council, located right inside Bank Negara Malaysia. If Rumbia is unsure if their fully automated upgrade qualifies them for high tax brand, they don't have to guess. They can contact the Secretariat directly. They are the central hub for all queries and the guardian of this SME policy. So, in conclusion, these 3 sections, which is definition, identifier, and the secretariat, create a ecosystem that support businesses like Rumbia. It ensures that when a company decides to innovate, the policy framework is there to identify, track, and support them every step of the way.
As a conclusion, for Rumbia Berhad, investment appraisal ensures that capital is allocated to opportunities that contribute meaningfully to organizational success. The project requires a net initial outlay of RM2,110,200 and generates positive annual after-tax cash flows of RM440,646, with additional terminal cash flow of RM450,000. This indicates that the project is expected to provide positive cash inflows and is potentially acceptable, subject to further evaluation using NPV or IRR.
However, when the NPV and IRR were calculated, the NPV is negative and the IRR is less than cost of capital, which is 15%. The negative NPV would reduce the share price, firm's value and shareholders' wealth if accepted. While at 13.4343% of IRR, it's far below the company's minimum required rate of return at 15%, indicating poor profitability, meaning that the company can only yield 13.4343% in return instead of 15% return when reinvested. So, we recommended a few ways for the company to fully utilize its investment. By that, SMEs should use NPV and IRR to make smart investment decisions. The best approach is to choose projects with a positive NPV and higher rate than cost of capital 15%, ensuring financial stability and growth in line with the size, resources and goals of Malaysian SMEs.
So, small and medium enterprise SME are business classified based on employees, numbers and annual sales turnover. In Malaysia, having a standardized SME definition ensure consistency, fairness and clarity across government agencies and financial institutions. For Rumbia Sdn Bhd, being classified as a small enterprise in the manufacturing sector allows it to access SME specific incentive, tax treatment, financing and policy support. This standardized classification helps the government design effective SME policies while enabling firms like Rumbia Sdn Bhd to plan investment and expansions with greater certainty.
That's all from us. Thank you. Bye.
Bukan, jadi ni cangkul.
Existing is
Satu, dua, tiga.